Hi friends, when we get our first salary, what do? Well, some will go and offer 11 rupees of prasad to the god, and the remaining salary will go in buying gifts for themselves or for their parents, girlfriend, boyfriend, etc. In my case, back in 2004, I did something very similar, wherein from my first few salaries, I saved 1 lakh rupees and I gave a check of 1 lakh rupees to my father. And to be honest, I can't put any returns on the joy that I saw on my father's face, and I think that was my best earned 1 lakh rupees in my entire earning life. So the point is, for the first few salaries, it's absolutely fine to do what we want to do with that salary because we have been waiting to earn that salary maybe for 20 years. But after that, one needs to start doing financial planning for their entire life. And back in 2010, I took my first term insurance policy. And at that time, I started paying 8,600 rupees per month for my life insurance policy. And to be honest, I believe that term insurance is as relevant as it was 14 years back, because while globally road accidents have come down significantly, in India, it is a totally different story. In India, the death rates due to accidents have gone up by 9.5% as per a latest report published in 2023. Unfortunately, death by heart attacks also have been growing in India. These are life's uncontrollables. They can happen to anyone, anytime, without any proper reasons. So having term insurance is even more relevant now versus what it was in 10 years ago, 15 years ago. Having said that, buying life insurance is so confusing, oh my god. Zero cost term plan, various riders, claim settlement ratio, how much of cover, how much of duration, it is so confusing. There is more confusion than clarity. So in this video, I will explain to you 5 term insurance features that agents are not explaining at all. Feature number 1 is insurance cover amount. Please get this right, otherwise you are going to regret, because agents will try to sell you insurance of, sir, please take 50 lakhs of insurance. Sir, please take 1 crore insurance, because they know the premium of these 50 lakhs of 1 crore is going to be relatively cheaper and they can sell it easily. For example, they will say to you that take XYZ insurance because 1 crore insurance is only going to cost you 1000 rupees per month. But this could be very, very bad decision for you. Why? Because let's say you are a 25-year-old and you are going for 1 crore of insurance. Now, if I consider 5% inflation rate, by the time you become 35 years of age, the purchasing power of this 1 crore will come down to 61 lakhs. And by the time you are 45 years of age, this 1 crores purchasing power will come down to even 37 lakh rupees. At 55, the purchasing power of 1 crore now will become 23 lakhs. And guess what? At the age of 65, purchasing power of 1 crore will come down to only 14 lakh rupees. So as the time passes, the purchasing power of money will gradually come down, and this 1 crore, will this be sufficient for you at the age of 35, 45, 55? Of course not. Rahul, no big deal. I will top up my insurance cover at that time. What's the big deal about it? Well, let me tell you this, that the most standard insurance policy providers will not allow you to change your sum insurance amount. If you want to increase your cover amount, most likely you are going to need to take additional policy. And just imagine, if you're taking additional policy at the age of 35 or 45 or 55, your premium is going to be very, very high. It is going to be nonsense premium. So the $1 million question is how to calculate insurance amount properly upfront so that you make a right decision. So in order to calculate the right insurance cover amount, let me take you to a very good calculator developed by Ditto Insurance Platform. What you see on my screen is you have to enter few parameters such as, let's say, your age. So let's assume that your age right now is, let's say, 30 years of age. Second is selecting the duration. So for duration, let's say you want to take a policy up until 60 years of your age. I will explain to you what is the right duration in the next few minutes. But for now, let's consider only 60 years of age. And let's say your monthly expenses are roughly 50,000 rupees per month. You also have outstanding loans such as your car loan, your home loan, education loan, all types of loan you put together. Let's say you have 30 lakh rupees of outstanding loan with you. When you hit the calculate button, you are going to see that you need 2.4 crore rupees of insurance cover. Why? Because your 50,000 rupees per month that you are spending in 2024 is going to be 2.27 lakh per month by the time you hit 2054, because the calculator has automatically considered 5% of inflation rate. And this is how in just few clicks you can calculate your sum insurance provider upfront. Also, you can call Ditto Insurance, which is India's highest rated insurance platform. Ditto Insurance platform is a no spam insurance platform, and also they offer personalized and honest term insurance advice. Their experts have received 4.9 Google rating. They are backed by Zerodha, so you can trust them. In fact, you can get a free 30 minutes consultation from Ditto's expert advisors. They also have a lot of free resources like term insurance checklist, term insurance 101, free calculator, etc. Simply go to the link provided in the description or in the pinned comments. Fill your personal details, select a date and time that suits you. Sit back and wait for a call from Ditto's expert advisors for absolutely free. Moving on to the second feature, which is the life stage plan rider, extremely important for you. Since we have just done the calculation of sum insured amount, you might have a natural question here that Rahul, in the next few years, my life might have some important milestones, such as I might get married, or I might have children, or I might need to take care of my parents, or I might have some unexpected life stage events. How do I factor all of that into my calculation right now? So for this, many life insurance providers provide a rider called life stage plan rider. If you add this rider at the time of buying the insurance, what it will allow you to do is it will allow you to have the flexibility to increase your sum assured at specific life stage events later on in the future. So for example, let's say if you are 30 years of age right now and you have 1 crore rupees of insurance cover already. At the age of 35, let's say you are blessed with 2 twin daughters, and all of a sudden you become very responsible and you realize that, you know what, 1 crore is not going to be sufficient. I want to increase it by 50 lakh rupees. I want to go for 1.5 crores. At that time, at the age of 35, you can go ahead and ask your insurance provider to increase your sum assured amount from 1 crore to 1.5 crores, provided at the time of taking the policy you had this life stage plan rider. And the beauty is that you will not need to go through a lot of hassles at the age of 35 when you are ready to increase your sum assured amount. Now please be aware that it is not that once you take the life stage rider cover you can increase your cover amount to whatever amount you like. No, it doesn't work like that. So for example, if you have 1 crore of amount right now and if you go for life stage rider cover, the insurance provider may provide you a flexibility of adding, let's say, 50 lakhs or 50% of your insured amount, which is again 50 lakhs, whichever is lower is what you can add. So it's not that you can make this 1 crore cover amount to 3 crores amount later on at the time of 35 years of age. That doesn't work. So therefore, it is absolutely important to go back to point number 1, where you have considered few of these factors already into your calculation as much as you can do, because life stage plan does not give you unlimited cover amount later on. Also, second point that you need to understand is when you increase your cover amount at the age of 35, naturally your premium will also need to go up, but at least you have the option to increase your cover amount. It's not that you have to take out brand new policy at the age of 35. So that's the advantage that a life stage plan rider offers you. So it is something that you can consider. And again, if you are not sure, please give a call to Ditto Insurance Providers expert advisors, and they will help you out to select whether life stage plan rider is good for you or not. Moving on to number 3, which is critical illness rider, an extremely important rider that you must be aware about. This is because unfortunately, if somebody gets detected with a critical illness, they will be eligible to get a portion of their sum insured amount as soon as the critical illness is identified. So take an example here. Let's say Mr. X had an insurance cover of 2 crore rupees and they also had critical illness rider attached to this policy. And the policy states that out of this 2 crore rupees, 50 lakhs would be given to Mr. X in case a critical illness is detected, and this 50 lakhs will be given as soon as the critical illness is detected. And let's now assume that unfortunately Mr. X is detected with cancer. So just because Mr. X had the critical illness rider attached, they will be given 50 lakh rupees immediately. And can you imagine the huge impact this 50 lakhs will have on them? They can stop working for a while. They can start their treatment for such a horrible disease immediately without worrying about money. Their household expenses can continue to go as it is. They don't need to panic or worry right now when they really need to take care of their health. So in my view, critical illness rider is an extremely important rider that everybody must consider. Number 4 is policy duration. So Rahul, we are very clear now in terms of the cover amount. We know the 2 important riders that you have just now explained. What about the cover duration? How long should be our policy for? Shall I go for a whole life insurance cover that takes me up to 99 years of age? Because ultimately I want to recover all my money from insurance company. See, whole life insurance covers are costly. They are costly like 4 to 10 times than the regular insurance covers. And why do you need a policy up until 99 years of age? Do you want to die after 99 years of age and take this money with you and offer it to God? See, the basic principle of term insurance is I need a term insurance policy to cover my or my dependents' future expenses in case I am not there. So the day I become financially independent, meaning I have enough money to take care of my dependents' expenses such as my kids' wedding expenses, kids' education, the inheritance that I want to leave behind, me and my wife's retirement pot, our travel plans, and a lot of future expenses, if I know that I have taken care of them, at that time, I don't need term insurance policy. And in my case, I want to be financially independent by 2030. So therefore, the duration of your cover should be the age at which you want to become financially independent. And if you have no idea right now, that's absolutely fine. So in that case, you go for a standard policy cover of 60 years of age. So far, if you're liking this video, humble request to hit the like button. Let me know in the comments a simple thank you. It will motivate me to create content for you at zero cost. Let's now move to number 5. Which is return of premium and zero cost term plan. Absolutely important for you to understand these two trending topics when it comes to insurance. In fact, I had created a full video on this topic. You will find the link in the description. But let me give you 2 to 3 minutes of commentary on these two topics so that you understand the high level view of it. So let me first explain return of premium plan. So let's say you take a policy for 40 years with a return of premium plan and you pay 2,000 rupees per month. Now, because you've taken return of premium plan, after 40 years, if you are still alive, you're going to get all the premium that you've paid in the 40 years back to your account. So in this case, 2,000 per month for 40 years comes out to be 9,60,000 rupees. So after 40 years, you are going to get 9,60,000 rupees if you are alive. This sounds very, very good, and this is how it is sold in the market. But what if you did not take the return of premium plan? Which means you get nothing back after 40 years, even if you are alive. Now the beauty is that if you do not take return of premium plan and if you take a regular cover for 40 years, your premium is going to be much lower. In majority of the cases, it is going to be lower by 50%. So the example we took of 2,000 rupees per month with return of premium plan, you may only need to pay 1,000 rupees per month without return of premium plan. Means you will save 1,000 rupees per month in the premium for the 40 years of time. Now, if you put this 1,000 rupees per month for 40 years in a fixed deposit at 8% rate of return, this 1,000 rupees per month is going to become 35 lakh rupees after 40 years. And if you compare this 35 lakh rupees with 9 lakh rupees 60,000 that you got in the return of premium plan, you're going to be in much more benefit if you do not take the return of premium plan. If I consider 10% rate of return, it goes to 63 lakhs. 12%, 1 crore, 18 lakhs. 15%, 3 crores, 14 lakhs. And it all depends on how much of returns you can generate out of that 1,000 rupees per month that you are going to save if you do not take return of premium plans. Now let me speak about zero cost term plan. If you take a zero cost term plan, essentially what you're doing is you are buying a flexibility to end your policy before your cover duration and get all your premium back. So how is this different from return of premium? See, in return of premium, you get all your premium back only after the policy is finished. And secondly, with return of premium, you are likely to pay almost double the premium as compared to a regular plan. While in case of zero cost term plan, you get all your premium back provided you finish your policy earlier than your end duration. Now, typically, if somebody gets financially independent much earlier than the policy duration, let's say you take a policy for 60 years of age, but by the time you hit 50 years of age, you are already financially independent. In that case, you don't want to continue to pay your insurance premium between 50 years to 60 years of age. And also you want to take all your premiums back that you have paid. In that case, zero cost term plan will give you that flexibility at the age of 50. So when you're buying the term insurance, you can go for zero cost term plans. However, please make sure if you're buying zero cost term plan, you have to ask the agent what is the extra premium you are going to pay, if at all you are going to pay zero cost term plan. There are insurance providers who will offer you zero cost term plan at extra premium, and there are insurance providers who will not charge you any additional amount on top of your regular premium even if you go for zero cost term plan. So please be careful, and if you are not sure, please give a call to Ditto Insurance Platform Provider. Their expert advisors will guide you step by step and will explain to you zero cost term plan and which insurance platform providers are offering zero cost term plan at no additional premium. You will find the link in the description or in the pinned comments. So these are the 5 features that I wanted to explain to you that agents are not going to explain you. Also, I request you to watch this video now, which is on health insurance, an extremely important video that will educate you a lot. And I hope to see you in my next video. Until then, keep rocking.